Silicon Valley Bank has been collapsing, folks, and the last couple of days have been an absolute mess. What can we as investors learn from this entire scenario? Well, in this video, I'm going to cover just that. For those who are new to the channel, my name is Leo. I'm a value investor. I love covering stocks, evaluating them from a very strong numeric perspective. Now, analyzing this company has been an absolute disaster, considering the fact that Jim Cramer said last week, or last month rather, it was a phenomenal buy. No, when you have a business as over leveraged as this, investing your funds into poor asset decisions, you get the perfect storm. You have a company where predominantly a lot of its clients, a majority of its clients, are tech startups, people in the crypto space. These are two industries that benefit from low interest rates. However, interest rates will not be low forever, which is clearly evident. Interest rates have been hiking higher and higher to combat massive inflation that has been ravaging through the US. What can we learn? Well, one, high leverage is not always a good thing, and it's quite evident here. And load this up here in the stock spec software. This is a software I use to analyze companies. And here's the thing, folks. Look at this debt to equity ratio. This debt to equity ratio is currently 1,200%. Now, when I analyze, let's say, typical like securities, like Apple or whatever, under 50% is a phenomenal number to go by. Banks kind of operate in a little bit of a different fashion because you deposit money into the bank. They take that money and invest it into said asset classes. They'll get a return based off the money they lend out. However, if they're unable to do that, that is where things kind of get messed up. And that's why the high interest rates have been crushing this company. When interest rates increase, tech companies typically don't like that because they like to be able to borrow money cheap and fuel their R&D. And the last 10 years have been very, very great for anything in the tech space. So much so that Silicon Valley Bank has put a lot of its trust into its clients being new tech startups. Now, here's the problem with a lot of new companies, and something I've been bringing up on my channel before. I personally don't like investing into new tech companies or new companies for any kind of industry or sector for that matter. And the main reason is they don't generate money typically. Here's the thing. It's like you're throwing darts in the dark, and hopefully that one of those darts actually hit the board. Had majority of their clients be these new tech startup companies. Now, all of that is failing, along with the fact that they invested into long-term treasury bills. Now, here's the thing, folks, a small little lesson for those who are new to treasury bills or bonds for that matter. When a treasury bill is introduced, you can buy it at different lengths. Typically, the shorter the duration, the less risky it is if you hold that bill to that duration and then afterwards sell it to what's called to maturity. Now, the longer it is, imagine almost like a teeter-totter, the more riskier it is. However, it typically yields more. So, what did Silicon Valley Bank do? Well, they anticipated interest rates to continue to stay low. So they invested into these 10-year treasury bills. Not the brightest idea. So the price and interest rate of a treasury bill or a bond for that matter are inversely correlated. If you're planning to, let's say, bank on interest rates going down and you want to sell at a capital gain, you'd buy, let's say, a long-term treasury bill or a bond, because then after when interest rates shrink, that price is going to go up. So it's going to be worth more. However, the inverse happened. So they bought a lot of these treasury bills that were expiring late, went down in price, and now they have to sell them at a loss because they needed liquidation. They needed money. And essentially, how do banks work? Well, you make a deposit as their client, as their customer. They take that money and invest it. So it's a perfect storm of just mismanaging money into different companies, into different asset classes. They literally just messed up being a bank. Now, it looks like the US government is trying to help out depositors because those are the ones that are really affected by this business. The $250K are going to be covered by the FDIC, but that can only stretch so far because this bank has lost billions. I don't think this is going to cause a major contagion with other investment banks. However, when you're analyzing, let's say, into a financial institution, this is where things kind of get a little bit tricky. Their return for your portfolio is based upon what they invest in. If you're investing in a company such as Silicon Valley Bank, where it's so highly concentrated into risky startups, well, the risks ahead will be such as this. How does this translate to other companies? Well, if you're seeing a company that's extremely sensitive to interest rates, now might be the time to just ease off a little bit. The US government is not planning to bail out Silicon Valley Bank, which I think is ultimately a good thing. If this bank was meant to fail, it should fail. I think they've learned their lesson from the 08-09 crash, which I think taught us a lot of lessons based off of how leveraged a company or bank can be. Personally, I don't like investing into financial institutions for this reason, but if I'm going to invest into a bank or any kind of financial institution, I like banks that are extremely conservative. I think this whole scenario here, this SVB crisis, is definitely a one-off, just because of how focused they were in that one niche. And it was a nail. They hit the nail on the head for the last 10 years of just investing in these companies, making huge returns, getting to the point where now they became the 16th largest bank in America. However, high risk game will give you, let's say, a high risk reward. However, there's also the consequences that come with that, and unfortunately they are hitting that consequence, and those who are paying for it are the depositors. Mainly this comes down to a video based upon why I think that debt to equity ratio is so important, because if you're going to invest into a highly leveraged company such as this, the lesson to be learned here is with high leverage becomes high risk and high reward, but most often than none, folks, the consequences outweigh the reward in most case scenarios, and this is clearly evident here. I ultimately think that this is just a one-off scenario. I don't think this will potentially spread, and a lot of reporters are also saying this as well, that it'll spread to other banking institutions in the US, because ultimately if the banking system fails like twice, it's done. That's it. Call it a day. It would be an absolute shit show. So ultimately, I think this is just a one-off scenario. It's unfortunate that the people that have their money deposited are going to be affected. However, I don't think it's going to be affecting tons of other banks. However, I think the important thing is to look at your portfolio, look at the companies you're invested in, see how much they are leveraged. Because if they have a high debt to equity ratio, you know what? I might need to take a decent look to say, hey, if economic conditions get worse, are they able to weather the storm? That's ultimately what we're trying to find here, folks, on the channel. Just great companies that can weather storms such as this. So that's what I'm trying to find here, and hopefully you got something out of this video. If you found it helpful and you want to get your hands on the software, 7-day free trial, follow the links in the description box below. I think you'll love it. It's a great stock screener tool to find out what you're actually paying for your investments and have an understanding of what you're actually buying. In case you're a new investor, this is the software you need in your toolbox. So with that in mind, folks, I will see you in the next video. Thank you so much for watching. If you enjoyed this video, make sure you don't miss out on this stock right here. Now, I believe this might be the potentially best investment going forward in 2023, given everything that's happening.